Good morning or good afternoon to you all. My name is Lamar Montolano. I am the Digital Marketing Manager of CRU, and I'd like to be the first to welcome you to this, hopefully in this series of webinars. Today's webinar is titled Metals and Mining Observer, Outlook for 2018 and Beyond. I'm here just to introduce you to today's webinar, and admittedly, some of you may not be aware of CRU and what we do. So here's a little slide just to explain what we do. As you can see, we have various locations across the world. Our head office is in London, and we also have our offices in Pittsburgh, Santiago, Mumbai, and Beijing. A few housekeeping rules for today's webinar. All of you are in listen-only mode. However, we do encourage interaction. You'll see on the panel, on the GoToWebinar panel, there is a questions box, which if you expand, you can text in your question for our speakers. Please bear in mind that any questions that you submit will be answered anonymously. We will not mention your name nor your company. One last thing before I hand over to the speakers. This webinar will be recorded. So hopefully by the end of this week, you will all receive an email with a video recording of today's webinar, so you can enjoy this webinar all over again at your own time. So today's speakers are Aleksandar Popovic, Senior Consultant here in London, as well as Ben Jones, who is our Principal Consultant. Both of our gentlemen work in the consulting team. And with that, I shall hand over to Ben.
Thanks very much, Lamar. I'm Ben Jones. I head up the multi-commodity consulting here at CRU. We spend a lot of time as part of this work thinking about cross-cutting themes as they bear on demand, supply, prices, trade and investment in a range of commodities falling under our remit. I'm very much looking forward to introducing you to Alex Popovic, who's going to talk about some of the rich fruits of some of our analysis during the course of the next 20-30 minutes. And after that, as Lamar points out, we're happy to field questions. Right, over to you, Alex.
Thank you very much, Ben. Thank you very much, Lamar. And thanks to everyone here for joining us today. Before we get going, I would like to mention three things. First, I would like to thank everyone here for participating in our industry survey. Your contribution and views are always greatly appreciated, and we hope that sharing the results today will be a useful piece of insight on where the consensus lies in way of sentiment and industry themes today. Second, our industry, metals, mining and fertilizers, is of course a large industry with many product markets and market participants. We appreciate that everyone here today will have a unique focus and area of interest, and while we hope the underlying analysis of fundamentals will provide granularity and relevance to each of you, the commentary and discussion is primarily focused on the key developments in our industry and the overriding themes. Finally, I would like to highlight that you should all have the facility to enter questions should any arise during the course of the presentation. Today then, we will talk about industry fundamentals and trends across coal, ferrous, base metals, precious metals and fertilizers, and the overriding market and corporate themes today and for the year ahead. We will discuss sentiment in the context of commodity markets and key market and industry themes, citing feedback from the survey. We will look into the macro backdrop and its implication for demand, the production landscape, industry costs, investment, and finally the outlook for prices for the year ahead. So let's start by talking about sentiment. Despite some price divergence across the commodities basket in the last 12 months, the positive recovery in the industry has brought about a significant improvement in financials and industry sentiment. CRU's market size indicator, which multiplies average prices and volumes and is shown on the top left-hand chart, is up 21% year-on-year with a strong Q3 led by bulks and, more importantly, base metals. A sense of improved optimism is supported by the results from CRU's industry survey conducted as part of this service. Shown in the bottom left chart is the output for more than 200 responses, with the results implying that market optimism has picked up in the last 6 months, with around 2/3 of participants optimistic about the year ahead, up from around half when the survey was last conducted in May earlier this year. The more bullish expectations today principally reflect stronger macro data, ongoing supply-side reform in China, an area we're going to briefly discuss later on, and improved growth expectations for metals, partly driven by rapidly changing expectations around growth in new energy vehicles, or NEVs. 6 months ago, it was far from certain that the recovery in mining would be sustained. And likewise, uncertainty around the future direction for the industry remains a concern for market participants today. Going back to the top left chart, we are projecting CRU's market size indicator to decline by some 10% over the next 12 months, reflecting the partial unwinding of previous price gains for investment-driven bulk commodities and a more stable outlook for base metals, precious metals, and fertilizers. Sentiment across the industry at least appears positive for metals and mining in 2018. Turning to key themes affecting the industry, on the top left and top right charts, we show the market and corporate themes based on responses received from CRU's industry survey. Interestingly, the results from the survey suggest that while structural economic and policy risks still dominate market attention, they are increasingly focused on domestic rather than international issues, including supply-side and environmental policy reform in China and elsewhere. Concerns around the Chinese investment slowdown still dominate to the downside, but a managed economic transition now appears more likely, at least in the near term. Importantly, the cooling down of the Chinese debt is fraught with risks, and these issues remain far from resolved. In terms of emerging themes, rapidly changing expectations on the transition to a low-carbon mobility and energy futures has been partly responsible for driving positive industry sentiment in Q3 2017, given its potential profound implications for metals markets. We will briefly touch on this when we talk about demand later on. Looking to corporate themes, an ongoing focus on managing supply-side fundamentals, such as technology, productivity, and labor relations, remains important, but the main story in the last 6 months has been the re-emergence of growth as a key corporate priority, with newer energy vehicles increasingly seen as a major market opportunity. 6 months ago, it was unclear what miners will do with their cash, with diverging views on whether we will see a return to capex growth or more focus on debt reduction. Today, it appears that the previously mixed outlook on investment strategies has been replaced by clearer expectations on a return to both organic and inorganic sources of growth. Summarizing then, environmental and supply-side reform, the transition to a low-carbon mobility and energy future, and stronger corporate focus on growth emerge as key themes in Q3 2017. Turning to the economic backdrop, our view is one of a positive outlook for the global economy, despite risks from Fed tightening and China deleveraging. Globally, we are expecting GDP growth of around 3% in 2017 and 2018, which is a significant improvement on 2016, which stood at around 2.4%. Indeed, it has been quite a broad-based recovery, with growth in both emerging and developed economies, and particularly strong economic performance in the US, as well as in China, and a recovery in the Eurozone and Japan, albeit below long-term historical trends. The outlook for metals demand indicators, such as industrial output, vehicle production, and construction, as shown in the bottom left chart, appear reasonably robust going into 2018, albeit slightly below our expectations for 2017. Despite the recovery, however, and the reasonably robust outlook for 2018, risks from Fed tightening and China deleveraging are the key areas to monitor going into 2018. In China, the faster than expected GDP growth in the first half of 2017 means that the growth target of around 6.5% can be met whilst starting to rein in some very loose monetary and fiscal policy. It also implies less need for government to fund infrastructure investment in order to support GDP growth. October's 19th Party Congress may give further insight into plans for reforming the debt fuel economy. Our base case is for a managed transition to GDP growth of around 6%, with investment in construction seeing the greatest deceleration during the slowdown. Notably, downside risks dominate here as the cooling down of the Chinese debt is fraught with risks. Turning to the outlook for metals demand and minerals demand, there are a few main observations to our view of the next 12 months. First, and with reference to the top left-hand chart, which shows metal demand growth on the x-axis by key driver, we are projecting demand growth across the whole mined commodities basket, including coal. Second, there are marked differences in the expected demand-side performance between metals. For instance, demand for stainless steel, and by extension nickel and chrome, and demand for aluminium, both of which are well diversified across end uses and are more mid to late cycle commodities given their use in consumer goods, are expected to see robust demand growth of around 4 to 5% across most major regions and geographic markets. This is more than double the growth expected in carbon steel, which will come less from China and increasingly from India, Southeast Asia, and Africa in the coming years. Having said this, it's important to bear in mind that even a modest 1 to 2% growth in carbon steel is worth more in dollar terms than growth in the rest of the commodities and metals combined. Steel and steel-making raw materials remain the largest driver in value terms, despite the lower growth rates. Similar is true of coal, which following a few years of decline is expected to return to modest demand growth in 2017 and 2018, despite longer-term structural challenges. Growth in demand is expected as a result of continued generation investment in India and stronger power demand, as well as hydro generation shortfalls in China this year. On the fertilizer side, demand for the key nutrients is expected to diverge due to changing crop ratios, nutrient requirements, and Chinese agricultural subsidy reform. The final point I would like to make with reference to the top left chart is the acceleration in the green economy, notably the importance of major changes emerging in the transport and energy storage sector. The greening of transport and power is gathering pace, with new energy vehicles increasingly seen as a major long-term market opportunity. And this is not just true for cobalt and lithium, which are forecast to see continued vigorous demand growth in the next 12 months. The bottom left-hand chart shows possible supply-side implications, assuming a number of market, technology and policy choices for a range of mined commodities, and assuming a 10% sales share for new energy vehicles. While cobalt and lithium are expected to require the most significant growth in supply, significant investment in both upstream and downstream will also be required for nickel, copper, manganese, graphite, and many other raw materials which could feature in the future energy mix. Importantly, much of the current supply of nickel and manganese is in the form of ferroalloys, not suitable for battery application. The share of Class 1 supply, which is required for such applications, and is shown in the red triangles for nickel and manganese, is much higher than that of total mined output. Disruptive change to the transport sector, therefore, will not only profoundly impact the volumes of resources required, but will reshape the value chains for many raw materials. Turning to the supply picture, there are two main themes to our view of the next 12 months. Supply-side reform in China and slowing output growth amid declining upstream capex for new projects in the last couple of years. On the subject of Chinese supply-side reform, the top left chart shows year-on-year Chinese capacity change for the 2015 to 2017 period for two industries, aluminium and steel. The blue bars show effective year total capacity estimates, while the colored stacks show net changes as a result of closures, both permanent and temporary, restarts and new expansions. It is becoming clear that recent Chinese supply reforms have been the most effective attempt to date at addressing the issue of structural overcapacity, surprising many market participants and observers. We estimate net capacity growth in aluminium will decline from around 8% in 2016 to 5% in 2017, while in steel the rate and extent of closures has accelerated, declining from around -4% to -9% in 2017. Notably, the difference in these industries is partly down to underlying differences in demand growth, as well as the ability to effectively service the seaborne market. Previous cuts have never been sufficient to balance the Chinese market, but recent developments have had a material impact on domestic and global balances, firming prices and pushing up utilization rates and margins. And not just in aluminium and steel, but most raw materials, including coal, fertilizers, ferroalloys, zinc, and needle coke, used in the production of graphite electrodes. Notably, most cuts have targeted smaller scale, less efficient, and mostly private enterprises, with SOEs expected to gain share as a result of ongoing supply-side reform, which we expect to continue in some form going forward. Moving to upstream, the bottom left chart shows projected year-on-year changes in metals production in dollar terms by commodity and by region between 2017 and 2018. While there are differences across the industry, our view is that growth in output is expected to slow across the basket of mined commodities amid declining upstream capex since prices started declining in 2012 and 2013. To give an idea of the extent of capex cuts, we estimate spending in new upstream developments to have been around 150 billion at its peak in 2012 and to have declined to just around 40 to 50 billion in 2016. In the case of copper, for instance, we're forecasting the slowest growth in copper output in more than a decade in 2017 and 2018, despite some new projects and mine restarts. While 2017 output has been severely affected by mine strikes and export license issues in China and Indonesia, 2018 is expected to see a slowdown as fewer large projects and expansions enter production. Similarly, iron ore supplies are stabilizing in Australia following rapid growth during the 2012 to 2016 period. And while we still expect growth in Brazil from S11D, some of this will come at the expense of Vale's other mines, as well as declines in domestic Chinese output. Notably, some rebound is expected in coal, driven in Australia, that is for metallurgical coal, and India, that's for thermal coal. Growth in output is also expected in fertilizers, principally in potash in Russia and North America, and phosphates in Morocco and Saudi Arabia. On balance, however, we are expecting fewer large new mines to enter production in 2018 than in the previous few years. In terms of costs, our analysis suggests that the factors that have contributed to cost decreases over the past few years are partially unwinding, with the result that we expect some inflation to return in 2017, another signal of the cyclical upturn in the last 12 months. The chart in the top left-hand corner shows CRU's view of cost changes between 2016 and 2017, by country and by key driver. Importantly, there are two offsetting developments, namely cost inflation on the right, principally driven by non-controllable costs, highlighted in blue, and cost savings on the left, principally driven by controllable factors, highlighted in red. While we are expecting some cost pass-through from slightly higher year average oil and currency appreciation, in particular in Russia, Brazil and Australia, I would like to point out to the increases in sustaining capex, higher royalty payments and higher consumables prices. And offsetting this, we expect to see continued implied productivity gains, which remains an important corporate priority in 2017. Drawing your attention to the bottom left-hand chart, which shows average industry profitability on the vertical axis, that is average margins, and the share of profitable versus non-profitable mines on the horizontal axis, that is how much of current supply is profitable. Based on our expectations of price developments in the next 12 months, we expect cash positions to moderate in bulks, with Chinese miners particularly sensitive, while margin expectations remain high in copper, nickel and zinc on a more bullish outlook for 2018. Turning to the investment picture, our view is for development capex to return to growth in 2018 from a low base for the first time in years, particularly in copper in Latin America, but also elsewhere, and in coal. This is expected to offset continuing declines in iron ore capex, reflecting the completion of several major developments such as the ramp-up in the Pilbara and S11D. In the last 6 months, we have seen improved cash positions and renewed interest in growth chase few projects, which has led to an uptick in valuations, particularly for projects with attractive commodity exposure in base and technology metals. Thinking to the medium term, it is often said that in every cycle is born the next, and here we see good evidence in the analysis shown on the bottom left-hand chart, which shows CRU's estimate of forecast supply gap in 10 years' time, and a ratio of recent prices against CRU's estimate of longer run marginal costs on the horizontal axis. 6 months ago, when we were looking at longer-term investment needs, we concluded that prices were insufficient to encourage significant new investment across many commodities, yielding potential medium-term supply gaps, particularly in copper. 6 months on, and copper and zinc have moved near or above the long-run marginal cost for the first time in years, indicating market visibility on future shortages and a possible return to incentive pricing, at least in the case of zinc. This is an exciting time for zinc and copper producers, as long talked about expectations of forecast supply deficits are gaining traction, not least due to the EV and electrification story. It will be interesting to see how the industry allocates capital in the next year and what prices we will see to incentivize a new round of mine developments. Similarly, we expect some other markets to follow suit, such as nickel, but whether this will happen in the next 12 months is subject to considerable uncertainty. In terms of price guidance, I would like to refer to the chart on the left, which shows historic year-on-year price performance on the vertical axis and forecast year-on-year price performance on the horizontal axis. The first thing to observe, of course, is that with the exception of the precious metals, prices across mining and metals have been appreciated in the last 12 months by around 20 to 40% on average. A more divergent picture is expected for the next 12 months, however. Bulks are set to continue cooling, reflecting adjustments to China core policy and a return to fundamentals. Copper, aluminium and zinc are expected to maintain a significant share of recent price gains, with upside in copper particularly evident given long lead times for projects, lack of swing capacity and the high level of incentive prices required for new investment. Vigorous demand growth and supply constraints are also set to sustain elevated cobalt prices over the next 12 months, while in lithium, prices are expected to be supported at current levels, reflecting execution and delivery risks to the current project pipeline. Importantly, while the chart presented highlights our view of the most plausible or likely outcome, the risk of price flare-ups or indeed sharp declines is certainly present and should not be discounted. A case in point have been the bulk materials markets this year, and we remain of the opinion that the sustained high price is possible given the right market and policy conditions. We are at an interesting point in the cycle today. We've observed a very strong recovery in the industry in the last 12 months, and while structural economic and policy risks still dominate to the downside, strengthening business sentiment, ongoing environmental and supply side reform, and rapidly changing expectations on new energy vehicles drive positive sentiment going into Q3 2017, with important implications for a previously mixed outlook on investment. Growth, both organic and inorganic, re-emerges as a key corporate priority, especially for projects with attractive commodity exposure and NEVs, which are seen as a major market opportunity in the industry. On the supply side, a return to cost inflation is another signal of the cyclical upturn, with potential to moderate margins, while price expectations are for continued divergence across commodities, with bulk set to cool and base and technology metals expected to remain elevated. Nevertheless, the risk of price flare-ups or sharp declines is certainly present, and it will be interesting to see how companies and governments navigate the year ahead and how they position themselves for long-term growth. Here at CRU, we make it our business to assess such eventualities in all these commodity and product markets, from understanding the drivers and likely outcomes of Chinese supply-side reform from our offices in Beijing, to critically appraising investment opportunities, or assessing the pace of possible EV penetration, renewable and grid storage, and the implications for natural resource markets. We believe we are in an exciting time for our industry, and both Ben and I will be more than happy to take some time and discuss this and any other questions that you have. Thank you very much for listening.
Thanks very much, Alex. I hope you agree that's a tremendously rich and broad set of insights on the commodity markets today and looking forward a year or so. Just reviewing some of the questions that have come in, quite a few relating to electric vehicles, both in terms of their future market shares and potentially what the impact might be for metals demand. So I'm sure we'll acknowledge that that's a pretty hot topic at the moment, and it's one in which we here at CRU have spent a good deal of time thinking about and developing quite sophisticated quantitative frameworks to allow us to capture different views on future technology, policy and economic conditions and how that might bear on the electric vehicle market. So specifically, we're currently forecasting global EV demand to more than double to around 11 million vehicles in a 5-year time frame, which represents about an 8 to 10% market share. So Alex has already talked quite a bit about what it might mean for metals. So we've seen already that for some of the smaller markets like cobalt and lithium, the impacts could be very significant indeed, with battery storage contributing on the order of 2/3 to 4/5 of demand in a 5-year time horizon. I think thinking about these impacts more holistically probably require looking in more detail at the wider infrastructure and power market impacts, and I think these issues are of particular relevance to copper producers, thermal coal producers. This is an area we are actively researching, and we will be keen to share further analytical results on this in due course. But I think the bottom line is that there's considerable upside for copper, considering these wider impacts, particularly in the wiring and broader infrastructure build out. And on thermal coal, well, the jury's out, I think, if the truth be told, but much depends on the capacity for excuse me, for grids to integrate new renewable capacity, and on the preferences of consumers to charge patiently overnight, or and the capacity to meet any additional demand through fixed storage. So just running through, we've got quite a few questions here, I should add, and I think a good deal too many than we can handle for the current setting. So I'll perhaps choose one or two more, and then we'll endeavour to respond to those whose questions haven't been picked up upon in emails and subsequent follow-up. So we've got one comment or a set of comments around where investments might best be made in the future. I guess as with any investment, this depends on where you start from in a portfolio sense, and the specifics of any investment proposal being considered. So thinking in purely market terms, which is where I think our expertise really lies, hopefully Alex's presentation has given you plenty of food for thought. So referring back to our price chart, for example, our view here, considered over a 12-month time frame, would point to opportunities in commodity markets, including cobalt, zinc, and perhaps nickel. In the longer term, with a more patient horizon, the need for investment, the apparent scarcity of projects, and the potential costs of bringing those on, I think would speak perhaps to investment in copper, potentially. So I think we're running out of time. I'll just pass you back to Limar.
Hello, and once again, thank you all for your time today for the webinar. There have been an abundance of questions, and as Ben touched upon, unfortunately we won't have time to answer them, but we do have your details, and we will contact you all individually with a response to your questions. So thank you for those. Alternatively, I know that a number of you are European-based. If you are in London during LME week, CRU is holding a breakfast event during the LME week, which you are welcome to attend. That will be taking place on the 31st of August in London. If you visit our website, crewgroup.com, you'll find more information in the events section. And also, while we're discussing events, Ben did touch upon earlier that NEV is obviously quite a topical topic right now. So if that is something that you are interested in, there is actually a NEV webinar taking place tomorrow. Again, details of that webinar, which is free to attend, can also be found on crewgroup.com. Lastly, I'd just like to remind everybody that the recording of this webinar will be available this week, hopefully, and so please look out for an email from CRU in your inbox this week. With that, I would like to thank you all for your time. Thank you.